Hello and welcome to Sounding Board, a community access television production of Seroptimus International of Novato. My name is Madeline Peters, and my guest today is Bruce Frankel, whom I will introduce in a moment. Seroptimus International is a global organization whose mission is to advance the status of women and girls, both locally and globally. So Bruce, thank you very much for being here, and I'll bring this up here. You're the author of this book, The Biggest Financial Mistakes Made by Successful Entrepreneurs. And you're going to focus now on the importance of understanding the basics of investment. So again, thanks for taking the time to meet with me in the studio.
My pleasure. Glad to be with you. The basics of investing, as I go around and try and educate folks and help them to understand that personal finance and investing doesn't have to be so complicated. And I think that the industry has done a lot, unfortunately, to make people have this feeling, right? We name things in the industry, some of these names of things that you look at and you just start to think, I could never understand that. But as you start to look into most of these things, most people can understand them if they're explained in normal people's language, right? So let's start doing that with a couple of things. So the first thing everyone hears about, what's a stock, right? What is a stock in a company? And if I buy a stock, what does that mean, really? A stock is a mechanism that enables average people in the public to own a piece of a company. So if I buy one share of stock in IBM, right? Now I own a little piece of IBM. I'm actually an owner. And people laugh about that and they say, well, it's a massive, big, huge corporation, but that's what stock really is. So if someone owns 100 shares, 1,000 shares, or 1,000,000 shares, they just own a little bit more of that company. And so in the olden days, right, they used to actually send out stock certificates. Right? I think we're going to show one. They were these beautiful pieces that the companies actually sent to you. Now, they did this because they wanted you to be proud of the company that you were now an owner in part of, right? So they would send these beautiful certificates. Sometimes people still order these certificates because they don't send certificates anymore.
Right. Now I remember them, and you do have this incredible visual of what a stock certificate looks like.
I mean, they were beautiful, really beautiful things. You can still, by the way, get them as kind of mementos for people. The companies, I think they charge you to get them now, but for gifting and things like that, right? So now that person, whoever bought those, a share, even one share, now is a part owner. Now, what are the benefits of that? If the company is doing well and they're growing and they're increasing their income, controlling their expenses, and doing well in the community, then that stock price has a great chance of increasing. So if I bought the stock for $10, the company's doing very well, it's increasing its value. So there's this term, increasing shareholder value. And that's really all it means, is because they are doing well with their company, they're able to grow the company and the stock price will go up. So that increases that shareholder's value in the company. Pretty basic, right?
Yeah, it is.
So the more you own and the better the company does, your assets, now we talk about balance sheet, right, in a previous segment that people can go back and look at. What's your personal balance sheet? And now if that stock is growing, that means your personal net worth is also growing. Now some companies, mainly larger companies, also pay out what's called a dividend, because the company has to do something with their profits. They either need to reinvest it, or they need to pay their people, they pay expenses, but when they have funds that are left over, if you will, then the other option, or in addition, is to pay that money back to the existing shareholders in what's called a dividend. So now you're benefiting by owning that company, and not just that the stock price goes up, but you could also be receiving a dividend. So that's another form of income for somebody. Now, I have to also say that stocks can go down, right? So if we didn't do such a good job of picking the company, right, or even the right time of picking the company, or the company's not doing well, or we hit it at a bad cycle in the economy, that stock can actually go down in price, and that's where we're losing money, and our net worth is going down when that happens. That's why it's important to pick good companies or have good advisors that pick good companies that are hopefully growing your assets. So that's a stock, and dividends that pay a stock. Now, the next thing is kind of on the other side of what we call asset allocation, right? How are we allocating your investments? Asset allocation. The other side of that allocation, and quite often, are in what's called bonds. Bonds are actually debt that governments or municipalities or corporations actually sell out into the open marketplace. So if I'm a company and I'm growing, I want to build a new building somewhere, for instance, and I don't have enough cash on hand to do that, I can sell bonds to the public, where I ask you to buy a bond that is probably worth $1,000, and you can buy many of them. And then as the company, I'm telling you, I'm going to pay you a regular interest rate back for you loaning me money, that $1,000. And the bonds will have a quoted rate that they're paying out in that interest rate. So what's 3%, 4%, 5%, whatever that may be. So it's a way for you as an investor to have what in a lot of cases is a more conservative side of your investments, and by lending money, buying bonds, in companies or municipalities that you believe in order to get that dividend, right? Or the interest, I should say. Now, can bonds go up and down in price, right? We talked about a stock. A stock can go up and down in price. It's important for people to understand that bonds can too. Now, the way a bond works is kind of like a teeter-totter, right? So if interest rates go up, the value or price of that bond is going to go down. The opposite is also true. If interest rates go down, the bond price is going to go up. So it's a teeter-totter. If we're in a rising interest rate environment, you may get more in that interest from buying bonds, but the price can fall. So it's important that people realize that when you buy a bond, you're not immunizing yourself from gains and losses. They tend to be more stable than stocks, but I don't want people to think that you can't lose money in bonds, because you can.
Well, I think that's very important to understand, and you've done a brilliant job of explaining the difference between stocks and bonds. So
next would be a mutual fund.
Yeah, though that's right. So could I have you comment on mutual funds?
So people hear a lot about mutual funds, and mutual funds tend to be more appropriate and suitable for people who are more risk averse, right? People who are more concerned about losing money, as well, smaller accounts. So when we're starting out, we usually use mutual funds than buying individual stocks or individual bonds. So a mutual fund is a company that has money managers working in that fund, that mutual fund, in order to pick the stocks for you, basically. Mm-hmm. So if it's a stock fund, they're out picking the stocks. If it's a bond fund, they're out picking the bonds. And then they pool them all together into a fund. And now the company goes out, and there's owners of that fund, and then you now own a piece of that fund, which owns all of these companies or all these bonds. So it's a way for someone to start investing, get a very diversified portfolio in one fund or a series of funds, and not have to do all that work about stock picking and all of that.
So it's a good entree then for people.
It
and
is.
It perhaps, what in terms of volatility, is it less volatile than, say, some of the other types of investments?
Great question. It depends. Now, mutual funds will have all different kinds of style. And so one mutual fund may specialize in investing in small companies that are just starting out or recently went public, and small companies tend to be more volatile. They also tend to be the big growers.
That's right.
So the volatility of a fund will depend on the style of that fund. Some are more conservative, some are more aggressive. Now, the best thing to do as far as creating a diversified portfolio, because everyone's heard that, we want you to diversify. So that mellows out or levels out a lot of the volatility that way. But you can, invest in mutual funds that are very, very aggressive as well. So I know people don't like the answer, it depends, but in this case, that it is what it is.
Well, I think you've described it very well in terms of separating out stocks, bonds, and mutual funds, and making the public aware that there is different levels of risk perhaps available, that is between those options and also within those options. So thank you very much for helping us understand the basics of investments.